All right, let's talk about Forex trading. If you've ever stared at one of those charts and just seen a wild, confusing mess of zigzagging lines, you are definitely in the right place. Today, we're going to demystify the whole thing and break down the actual strategies that traders use to find some order in all that chaos. So let's just get right to it. The number one question on pretty much everyone's mind. Is this whole Forex thing just a giant casino? Is it just a high-stakes bet on whether the line goes up or down? It's a totally fair question, and the answer? Well, the answer is what separates the people who succeed from everyone else. And the answer is a hard no. But, and this is a big but, only if you have a plan. You see, trading without a strategy is just gambling. The difference maker is having a repeatable, rule-based approach, and that's exactly what we're going to build right now. To build that plan, we first have to learn how to read what the market is telling us. So we're going to start with the two most fundamental strategies out there. These really are the bedrock of almost every other approach you'll ever see. You've probably heard this phrase a million times, right? The trend is your friend. And there's a really good reason it's so popular. It's the core philosophy behind the very first and maybe the most powerful strategy we're going to cover. Trying to fight the market's overall direction is just a recipe for disaster. And this, of course, is the trend-following strategy. The best way to think about it is like a river. You could try to swim against the current, right? But it's going to be exhausting and you're probably not going to get very far. Or you can just swim with the current and let its power do most of the work for you. That's what trend following's all about. So how does this actually work? Well, your first job is just to figure out the market's main direction. Is it generally pushing higher or is it falling lower? Once you've identified that main current, the strategy is super simple. You only look for chances to join it. If the market is in an uptrend, you ignore every single sell signal, period. This discipline is what keeps you on the right side of the market's momentum. Here's a perfect example for you. Let's say the Euro-USD pair is in a clear uptrend, making higher highs. A trend follower isn't going to just jump in and buy at the very top. No, they wait for a small temporary dip. We call that a pullback, and they see it as a sale. It's a discount, an opportunity to get in and ride the bigger move up. But here's the thing, markets don't trend forever. A lot of the time, they pause and they just move sideways, coiling up energy like a spring inside a tight little range, or a box. Our second strategy, breakout trading, is all about waiting for that moment the spring gets released and catching that explosive move that usually follows. The game plan here is all about patience. First, you draw your box. You mark the ceiling, which is resistance, and the floor, which is support. Then, you just wait for the price to break out with a strong, decisive move. But here's the key, and you can't forget this, you check the trading volume. A big spike in volume tells you the big players are behind this move, confirming it's for real and not just a trap, what we call a fake-out. So for instance, say the GBP/USD pair has been stuck, just banging its head against a major resistance level at 1.2750. When you finally see it punch through that ceiling with real power and conviction, that is your signal to get in on a buy, betting that the upward momentum is just getting started. Okay, so we have two core strategies, but which one is for you? The answer, you might be surprised, often depends less on the market and more on you, your personality, your schedule. This brings us to trading styles. And this is where you have to be really honest with yourself. Are you a patient swing trader? Someone who's happy checking the charts maybe once a day, holding a position for days or even weeks to catch a really big move? Or are you a scalper? Someone who thrives on that high-intensity action, making dozens of super fast trades a day for tiny little profits. One is like playing a slow, methodical game of chess. The other is like a fast-paced video game. There's no right answer, only what's right for you. Now, once you get the basics and you kind of understand your own style, you can start digging into some of the more advanced stuff. This is where we learn to stop thinking like a small retail trader and start thinking like the big institutions that actually move the market. And this brings us to what's called the smart money concept, or SMC. The basic idea here is that the big banks and institutions, they leave footprints when they trade. So instead of just drawing simple lines on a chart, SMC traders are looking for specific zones where huge orders were placed. They also track where most people are likely to put their safety nets, their stop losses, because these pools of liquidity act like magnets for price. So how does this work? Well, an SMC trader will spot a key zone where a huge move kicked off. Then, they wait for the market to make a really sharp, sudden move. We call this a liquidity sweep that looks like it's designed to knock everybody out of their positions. After that big shakeout, the price often snaps back to that initial zone, giving the SMC trader a really high probability entry. They're basically surfing in the wake of the institutional giants. So here's what that might look like in the real world. Imagine the USD-JPY pair suddenly drops like a rock, hitting a level where tons of buyers probably had their stop losses placed. That's your liquidity sweep. Then just as quickly, it reverses and slams into a key institutional zone you've already marked. That sharp rejection is your signal. The shakeout is over, and the smart money is now pushing the price higher. Now listen up. It doesn't matter what strategy you choose. Trend following, breakouts, SMC, none of it matters if you don't follow these next 4 rules. And these aren't just tips, okay? This is the unbreakable code for survival and long-term success in this game. Rule number 1, protect your capital. That is your first and only job. This means you should never, ever risk more than 1 to 2% of your entire trading account on a single trade. This is absolutely non-negotiable. And a stop loss is how you make sure you stick to it. Rule number 2 is all about making sure your wins are actually worth the risk. The potential profit on any trade should always be at least twice as big as your potential loss. We call this a risk-to-reward ratio of 1 to 2, or better. If you follow this rule, you can literally be wrong more often than you're right and still make money. Think about that. Okay, rule number 3 might just be the hardest one of all. You have to master your own mind. Trading brings out 2 really powerful emotions: greed when you're winning and fear when you're losing. You have to learn to control them, to accept that taking a loss is just a normal part of the business, and to never, ever jump back into the market just to win back the money you lost. That's called revenge trading, and it's the fastest way to blow up your account. And finally, rule number 4 brings us right back to where we started. Have a plan. Every single trade you take needs to be based on your rules, not a gut feeling or some random impulse. And the best way to hold yourself accountable is to keep a trading journal. Write down why you took a trade, what happened, and what you learned. That's how you actually get better. So, we've covered the foundational strategies, different trading styles, some advanced concepts, and the absolute unbreakable rules. All the pieces are on the table. The only question left is the one you have to answer for yourself. What's your plan going to be?